Hello guys, welcome back once again to the Financial Academy YouTube channel. Yes, of course. Welcome back once again to the Financial Academy YouTube channel. So, in today's video episode and in today's video, I'm going to be teaching you how to find high forex probability setup. Yes, of course. How to find high forex probability setup. Yes, of course. So, this video is for you. If you want to know on how to find a forex probability setup that will give you consistent profit on a long run, this video is for you. Please make sure to like this video, make sure to subscribe to my YouTube channel, and also make sure to comment down below if you have any single question concerning any of my videos. I get in me. Without any further ado, and without wasting much of our time, I will take you to my screen. When I take you to my screen, I'll be able to break down everything you need to know on how to find a high probability setup in trading. I go to me. So if you are seeing me for the first time, I teach content and videos concerning the financial market, including the forex trading, the stocks, and cryptocurrency market. So if this thing is what you like, make sure to like my videos, subscribe, and also share it to your loved ones. So follow me right now. Let me take you over to my screen without wasting much of our time. Let's go to my screen right now. Let's go. Let's break down and teach you everything you need to know. Let's go.
Hello guys, welcome back once again to my screen. Let's continue. How to find a high probability forex setup, a trader's complete guide. So this basically is teaching you what will help you and guide you on how to spot a high probability forex setup anytime and whenever you are in trading. Are you getting my point right now? Let's continue. Forex trading can often feel like searching for a needle in a haystack. The market moves consistently, driven by news, sentiment, and economic shifts. Yet, seasoned traders know that consistent profitability doesn't come from guessing. It comes from identifying and executing high probability setups. So in this video, we will walk you through with a high probability setup really and that is really working, the key principle behind them, and a step-by-step process to find them consistently. Is very, very important. Make sure to watch this video from the middle to the end so that you don't speak so that you grab a lot from this topic. What is a high probability setup? Ask yourself this question. A high probability setup is a specific market condition where multiple factors align to suggest a greater chance of a price moving in a certain direction. It is not a sure thing. Nothing is in trading, but it is a scenario where the risk to reward ratio is favorable and historically or statistically evidence support the trade idea. I get my point. Now, what are the key traits for such setup? Number one, you need to have a clear entry trigger. You need to have a well-defined stop loss and take profit level, which is number two. Then you need to have alignment with the broader trend or market structure, which is number three. Then number four, you need to have confluence of two or more analytical factors. Example, price action plus indicator plus support or resistance. Are you getting me? Then you need to understand this. What are the pillars of high probability trading? Yes. What are the pillars of high probability trading? Before scanning charts, you must internalize these foundational principles. Yes. Before scanning your chart, you must internalize these foundational principles. Number one, trend is your friend. Most high probability setup occur in the direction of prevailing trend. Trading against the trend can work, but typically requires more precision and carries high risk. Number two, confluence is king. One indicator giving a signal isn't enough. Confluence means multiple methods. Trend line, Fibonacci levels, moving averages, candlestick pattern, economic news all point to the same trading opportunity. Number three, risk management defines success. A setup is only high probability if you can define your risk upfront. Always know where you will exit if you are wrong before you enter. Then number 4, practice and selectivity, or patience and selectivity. The best traders might only take 2 to 3 trades per week. Waiting for true confluence prevents overtrading and emotional decisions. Step by step on how to find the setups. Step 1 is determine the higher time frame trend. Yes, of course. Start with the daily chart. It's very, very important. Is price making higher high and higher low? Then you know that it is uptrend. Or is price making lower high and lower low? Then you know it is downtrend. Can you also use a simple moving average like 200 EMA or 50 EMA to gauge trend direction? Example, if price is above 200 EMA and the EMA is above and 50 EMA is above the 200 EMA, the long-term trend is up. Then step 2 is this: identify key support and resistance level. Mark the obvious horizontal level where price have reacted before. Also note the dynamic support or resistance from trend line or moving averages. These zones are where price is likely to stall or reverse, ideally for planning entries. I get my point. Then step 3 is drop to a lower time frame for precision. Switch to the 4-hour or 1-hour time frame chart. Look at the same trend direction aligning with the higher time frame. Now, watch for price to approach those key levels you marked. Then step 4, wait for a price action signals or indicator confluence at or near this level. Look for a candlestick reversal pattern, whether it is pin bar, engulfing bars, inside bar, double top or bottom. Are you getting me? Then also look for indicator alignment. Example, RSI divergence, MACD crossing in the direction, or stochastic oversold in an uptrend pullback. Are you getting my point? Then step 5, apply additional confirmation, the confluence checklist before entering. Ask yourself, is this trade in the direction of the higher time frame? This is the first one you need to ask yourself. Is this trade in the direction of the higher time frame trend? Number 2 is this: is it at a clear support or resistance of Fibonacci retracement level? Example, 61.8%. Then the third question is this: is there a clear price action trigger? Then the first question is this: does an oscillator like RSI support the idea? Then the fifth question you need to ask yourself is this: is there any major economic news imminent that could invalidate this setup? If you get 4 to 5 years answers, you have a high probability setup. Are you getting me? Then step 6 is this: define your entry, stop loss and take profit. Are you getting my point? Entry: enter on the break of triggering candle, whether it is high or low, or immediately after the pattern completes. The next one is this: stop loss: place beyond the recent swing point that invalidates your idea. Risk only 1 to 2% of your trading account. Then the other one is take profit. Aim for a risk to reward for at least 1:1.5 or probably 1:2 or more. Consider taking partial profit at the next resistance level. Let me give you an example of high probability setup using my illustration. Number 1, trend pullback to a major key moving average plus bullish pin bar. Let's say that the daily trend is up. The price pull back at the 50 exponential moving average on the 4-hour chart forms a clear pin bar at the 50 EMA. Entry above the pin bar is high, stop below is low. Are you getting me? The second example is this: break and retest of a horizontal level. Price break above resistance on 4-hour chart. Later retest at the same level, now on support on the 1-hour chart. Forms a bullish engulfing pattern during retest. Entry on engulfing close stops below the retest low. Are you getting my point right now? Then the third example is RSI divergence at the major support. Price marks a lower low on daily chart. Then RSI marks a higher low on bullish divergence. At a major historical support zone, enter on first bullish candle, close after the divergence appears. So common pitfalls you need to avoid in this video. Common pitfalls you need to avoid for you to achieve this high probability setup. Number 1, ignoring the trend. Fighting the trend lower probability significantly. Yes, fighting the trend by going against the trend lowers probability significantly. The other one is trading without confluence. One signal is not enough. Yes, overcomplicating charts. Too many indicators causes confusion. Stick to 2 or 3 you understand very well. The other common pitfall you need to avoid is letting losses run. A high probability setup can still fail. Honor your stop loss. Another pitfall to avoid is forcing trades. No valid setup, stay out. The market will always offer another opportunity. Then my final thought on this video is this: finding high probability forex setup is a skill built on structure, patience, and discipline. It is by using high time frame alignment, key levels, and multiple factor confluence you shift the odds in your favor over the long run. I get my point. Remember, trading is a probability game. Even the best setup will fail sometimes. What matters is consistent execution of an edge with strict risk management. Start today. Review your past trades. How many had true confluence? How many were against the trend? Refine your checklist. Practice on demo account and gradually build the habit of selecting a higher quality trading. But you need to follow the disclaimer. Forex trading carries a high level of risk and may not be suitable for all investors. Past performance is not indicative of future results. This video is for educational purpose only and is not a financial advice. I get my point. So let me now go down to a breakdown of important time frame. If you are watching this video up to this moment, weekly, find a major trend and key levels. So these are the importance of time frame. Your weekly time frame helps you to find a major trend and key levels. Then your daily trend helps daily zone can give you a swing trading entry opportunity. Then third one is uses of 4-hour helps you to go entry zone for intraday trade, ideal for zones for Fibonacci placements. Are you getting me? Then the 15-minute chart, which is number 5, gives you price action on the lower time frame, which gives you confirmation for your entry. Are you getting me? So let's continue. The next one is this: two types of traders. Yes, in this diagram you can see 2 types of traders. Number 1 has no strategy. The first one has no backtested data. If that first one still doesn't have a journal trade, that first one trades on emotion, and that first one has no technical edge. So you don't want to align yourself with this type of trader, with this first type of trader. No, rather you should align yourself with the trader that have a clear strategy, with a trader that have backstated data. You should align yourself with trader that have detailed journal. You should align yourself with trader that trade objectively, not sentimentally. You should also align yourself with traders that have technical edge. So among these two traders, it's up to you to choose the one that you want to follow. But I would advise you to follow the second trader. Have this mindset. Don't follow the first trader. Are you getting my point right now? So there they continue. Let's watch this diagram. We have two people. We have John. We have Sally. John risked 25% risk per trade, and Sally risked 1% risk per trade, and their win rate is 50%, and their risk to reward ratio is 1:2, both of them. But look at what happened, so that you can find so that you can know the power of risk management. Over the next 8 trades, this is the outcome. Loss. So this first person was able to lose all his money and blow his account because of what? Poor risk management. This is the outcome of the 8th trade. Loss. Win. But before the first one was able to start winning, he have already blown all his capital away. And this is the outcome. The outcome for John, minus 25%, minus 25%, minus 25% on each trade. Minus 25% is equals to accounts blown. Then, but the outcome for Sally is minus 1%, minus 1%, minus 1%, minus 1%, plus 2%, plus 2%, plus 2%, plus 2%. At the end of the day, Sally is up to plus 4% because of what? Proper risk management. So this diagram is basically trying to tell you to apply proper risk management in trading. I'm telling you the truth. Apply proper risk management in trading. So this is basically what this diagram is all about. Applying proper risk management in trading. It is very, very important. Just look at the outcome. The outcome after over 8 trades. The other one the first one blew his account, and the other second one have a plus 4% gain because of risk management. He was consistent with his risk, risking just 1% of his account, while the other one is risking 25% of his account on each trade. So it doesn't make sense. So because in this life, we live to fight another day. So you need to keep your risk management religiously if you want to survive in this game for a long period of time. I get my point. So if you have watched this video up to this moment, please make sure to like this video, make sure to subscribe to my channel, and also comment down below. Comment risk management in the comment section, and I will see you on my next video episode. Please make sure to share this video to your loved ones. Okay, take care of yourself, stay safe, happy trading, and bye for now.